Howdy and welcome back. From the last video, I know that Bob wants to purchase some Bitcoin and he's decided to purchase them from Alice in exchange for dollars. Both Alice and Bob want to participate in the transfer without relying upon a third-party intermediary. Intermediary in this context means an entity who acts as a link between Alice and Bob in order to facilitate the transfer. Having an example of the functions involved with a typical trusted third-party intermediary is essential to understanding how the Bitcoin protocol executes a transfer of Bitcoin without the need for this trust. So, what functions does a trusted third-party intermediary provide? I'm going to use fiat currency like the US dollar, euro, pound, yen, or yuan as an example of an asset and banks as an example of a trusted third-party intermediary for transactions of this asset. So in this context, I'm going to look at what functions a bank provides in a transaction of fiat currency as a third-party intermediary. The first function of the bank pertinent to this discussion is account creation. The account is the participant's identity in the system. Other than the exchange of physical banknotes, in order to participate in a fiat system, one needs an account with the bank. Banks can provide access or restrict access to the system by allowing or denying creation or access to an account. Therefore, the participants are trusting the bank to handle account management equitably. The bank is also entrusted with creating a process where participants convey their intent to make a transfer. For example, banks provide check writing and online applications where account holders can initiate transfers of fiat currency. Participants trust the bank to ensure that the processes they provide for transfers are not susceptible to fraud and are therefore safe to make. Banks are also entrusted to validate the transfer or transactions of fiat currency. That is, the bank must validate the account holder's intent to make a transfer, as well as their right to make the transfer. Therefore, participants trust in the bank's ability to perform transaction validation. Banks are also entrusted to sort incoming transactions, maintain account balances, and ensure against double spending. If two transactions are presented for payment, one withdrawing $500 and the other $600, in an account that has a balance of $1,000, the order the transactions are processed has consequences. For example, which transaction will be paid first? Further, the bank is entrusted to maintain the balances of each account and monitor those balances in order to prevent double spending. Banks and the central bank that supports them are entrusted with the management of the overall supply of money in the system. Individual banks alter the overall supply of money by issuing loans, which adds to the money supply. Central banks alter the money supply by purchasing or selling assets from their member banks with money they create. That is, the money the central bank creates isn't transferred from another account, but instead the account balance is just increased by the central bank itself. The participants in a fiat currency system trust banks and the central bank to add or remove currency from the money supply in ways that are most equitable to all participants. Whether they are successful in accomplishing this in today's environment is hotly debated. Banks are also entrusted with the power to roll back or otherwise alter a transaction. Examples of rollbacks can result from a court judgment or be done on the basis of a mistake or from fraud. This can be considered a good feature or a bad feature depending upon your perspective. As I'll show later, a Bitcoin transaction cannot be rolled back. And again, this can be considered positively or negatively depending upon your perspective. Banks are also entrusted with the privacy of their account holders by either allowing or restricting access to account information by private or government entities. Finally, banks are entrusted with the power to create or deny the creation of an account, as well as allow or deny a transaction. This gives banks and the governments that can compel them to act an ability to censor a particular person or group. Once again, some would argue that this is a benefit of the system in that it addresses criminal transactions, rogue nations, and other would-be actors. On the other side, it's argued that censorship is a slippery slope and gives too much power to banks and governments. Although important, this discussion is beyond the scope of these videos, and for now, I'm just going to concentrate on how the Bitcoin protocol works. In sum, participants put a lot of trust in the banks as third-party intermediaries of fiat transactions. Hopefully this exploration into the trusted functions of a bank in a typical fiat transaction provides some insight into Bitcoin protocol requirements. That is, the Bitcoin protocol must implement most of these functions in such a way that participants are not required to trust any third-party intermediary and can instead independently verify each element and aspect of the transfer. So the question becomes, how does the Bitcoin protocol accomplish this without the need of a trusted third-party intermediary? I'll provide the answer to this cliffhanger in the next video. If you found this video helpful, please click the like button as well as the subscribe button. And thanks for watching.